Hey, everybody, welcome to another episode of the Never Lose a Deal podcast. This podcast is for real estate investors who want to know, learn, and know how to leverage creative financing to expand their real estate portfolio. And so today you are really going to enjoy what I want to discuss with you today, and that is about 1031 exchanges. Now, I decided to do this episode today because today, depending on when you're seeing this video, well, today is actually 1031. And most people refer to 1031 as Halloween, but I actually wanted to talk about 1031 exchanges. So, in the real estate community, this is considered 1031 day is 1031 exchange day. And that is why I decided to do this episode. And I actually held off on it because if you listen to my last podcast, we were talking about DSCR loans. I did a case study showing you how a DSCR loan would work. And so I had promised that I would give an example of how that would work with a 1031 exchange. And so I said, you know what? It would be great to just kind of hold off on the episode and actually do it on 1031. So there we have it. So depending on when you watch this video, just know that it was actually discussed on 1031 2024. And so let's go into today's topic. Now, if you are not aware, like I mentioned to you in the last podcast episode where I talked about DSCR loans, I gave an example of a New Jersey investment property here in my market. Of course, did not know the person selling the home, so I pulled an example of a home off of Zillow. It was a multifamily home. And if you remember in that example, which I will pull up shortly, I talked about the amount of money that would be needed because with DSCR loans, that particular example, the lender would provide 80% of the financing, and then, of course, the investor would have to come up with 20%. And so I gave an example of that. Of that 20% would be over $100,000. And so, depending on who is watching this video, there's going to be some people like, well, like who just has $100,000 just sitting around? Well, like as I mentioned in that video, lo and behold, there are plenty of people who do, and that is why on this podcast, I talk about a lot of advanced topics. Now, advanced being relative, but on this particular podcast, I'm not talking about elementary topics when it comes to real estate. So, in that episode, I talked about one of the ways is in a 1031 exchange, and that is what I want to talk about today. So, as always, want to give you some context to the 1031 conversation. Don't want to assume that people know what I'm talking about. So, I'm going to give an abbreviated version of it. So, a 1031 exchange is a federal tax statute that has been in place by the IRS, which allows real estate investors, it has to be an investment property, it cannot be your private home. Well, whereas the IRS partners with the real estate, now, of course, this is my words, it's not written in the law this way, but pretty much the IRS, the government, is partnering with the real estate investor to be able to defer taxes, capital gain taxes, primarily on a real estate purchase. Now, if you notice what I did not say avoid, I did not say trying to not pay. I'm talking about deferring, which is going to be a deferral of taxes. So there are some real estate investors who really want to be able to expand and they want to build out their portfolio. And by doing that, they want to leverage some of the tax laws that are out there that they can be able to use. And a 1031 exchange is one of those laws. Another thing of context that I want to talk about is that of the 1030 exchange, as I mentioned, it has to be an investment property. It cannot be a primary home. So it can't be you want to sell your primary home and and you want to offset a portion of the capital gains taxes. Now I know with primary homes, everything has to take in place in terms of phase outs and AGI and how long you have owned a home or what have you. But when it comes to an investment property, a lot of times when you do sell that property, there is capital gains that has to be paid. So a lot of times real estate investors, they're if they're doing the legal way, deferring taxes is really the legal way to be able to avoid paying taxes on that. And that is what I want to talk to you about today. So I'm going to talk about three key areas. Um, because I can literally talk hours about this particular topic, but I want you, for me, and to give you context of the example that I've showed, I want to give you an idea of what that would look like with the case study that I talked about. So let me pull up the case study. Now, for those who that may be the listening on the audience, understand that if you are watching this on if you're listening on Spotify, you currently can see my screen. And if you are looking at it on YouTube, you can see my screen. So the only individuals who cannot see my screen would just be the listening audience, and those are individuals on Apple and the other podcasting platforms. Now let's go back to the example. So talked about DSCR loans. We talked about the price of the home. It was listed as $545,000. Clearly $500,000. Like I said, here in my local market in New Jersey, down payment 25% of that was $136,000. So one may say, well, who are the individuals who would have that amount of cash? And so there are people who do, and that is where an investor um, who currently owns a property is looking to be able to buy another property. Now, one thing about the 1031 exchange is that it has to be like kind. So what like kind mean is that it has to be a property and a real estate property to a real estate property. So it can't be I'm going to sell my real estate property and I'm going to invest in I don't know, harvesting um, animals or something. IRS doesn't consider that like kind. So it has to be real estate for real estate. So normally when real estate investors leverage this tax law, they are looking to buy either a property that is of more magnitude, meaning it may be a more bigger or larger investment. So that is where this example would come in. So you can be that real estate investor who knows that, hey, I currently own a real estate asset that I am looking to sell because I have a lot of appreciation in it. I've owned it for a period of time, and I want to be able to capitalize off of that appreciation. Now, the good thing is that for the real estate investor who wants to do that, they don't have to worry about coming out of pocket with the down payment because the asset that they are selling will be used, the funds from that property will be used. Now, with the 1031 exchange, it has to be held with a custodian. So you cannot take possession of that money, meaning your title company, if you use a title company here in New Jersey, it is the law that we have to close with an attorney. And I know in some states you can just close with a title company, but here in New Jersey, you have to close with an attorney. So if the funds reach, meaning they go to a custodian, whether it is a title company or an attorney, and the check is given to you, of course, that is not going to work. So that 1031 exchange has to go to a custodian. And there is a period of time, because you don't have forever to be able to close on that next property. So understand the clock is ticking. So you have 45 days from the time that you close to be able to buy that new home, or should I say that new investment property. So some of the key areas that will make a 1031 exchange advantageous for the investor. Now, the one that I didn't write, but I just talked about it, is the ability to not have to use your own liquid savings in the bank. So the investor who would be looking to buy this, knowing that they have to put $136,000 down from the 545,000, they don't have to use liquid money of 136,000. That is one of the key areas. I don't have it written here on the screen, but that is something that is a plus. The first one that you do see on the screen, and I briefly talked about it in the beginning, is the ability to defer capital gains tax. Because since this is an investment property, the IRS has laws in place that if you are a real estate investor and you currently buy a property and you want to sell that property, any appreciation, hence that appreciation, is going to be taxed as a capital gain. The way that you can not pay that legally is to defer it. And that is where capital gains tax. So one of the key areas of a 1031 exchange is that it allows you to defer the capital gains tax. And understand that if done right, if you are working with a competent accountant, CPA, enrolled agent, or what have you, who understand the laws that are entailed with a 1031 exchange, along with working with the custodian, a 1031 exchange, a custodian, it will be a win-win for you as a real estate investor. So that is number one. Like I said, gave you a bonus with liquid, don't have to use your liquid cash. Number two, it allows you to transfer your wealth. One of the key pillars that we talk about here on the Never Lose a Deal podcast is the ability to be able to leverage financing to expand your portfolio and build wealth. This is an example of this, because with a 1031 exchange, the investor is looking to use this money to be able to buy a larger asset. So an investor may currently have an asset where the appreciation is there, but they're not getting as much cash flow as they would like to get from a particular property. Although they have a lot of appreciation, they may not have a lot of cash flow coming from that. Because one may say, well, wow, Lorelia, if the investor has so much appreciation, why don't they just keep the property, leverage the appreciation, and buy something else? Well, it really just depends. There's no right or wrong way. It is just it boils down to what really is the what is it that the real estate investor is really looking to achieve. And I don't mean just in terms of the real estate purchase, but I mean the overall strategy of what it is that they want in life. Maybe that real estate transaction that they're looking to liquidate and sell doesn't really fit into the new direction that they may be going as a real estate professional. So a lot of investors will do that. They may have feel like, hey, I'm not getting the cash flow that I want, but I do have a lot of appreciation. Let me liquidate this asset and move it on over to another asset. So understand, it's the ability to transfer your wealth, because not only are you expanding your portfolio, but you're also building wealth too. And that is why I've said on this podcast, we talk about creative ways for you to expand your portfolio. If you're a real estate investor, and you really want to go beyond the more advanced strategies that you can be able to leverage when it comes to financing, taxes, this is the podcast to listen to. So, we talked about one, capital gains tax, one of the key areas of 1031 exchange. Number two, we talked about the ability to transfer your wealth. And number three, I kind of talked about it with number two, high performing assets. What does that look like? Well, the asset that you currently have that you have liquidated may not be performing the way that you want. Hence, I just said cash flow. You're not getting as much cash flow. Yes, you have the appreciation, but you want to maybe get into a bigger game. So you'll see this with a lot of things. That is why I said you will be surprised with all the creative ways that you can be able to leverage real estate. So, this particular investor could want to, in my example, could want to um, liquidate the current asset that they have. They've owned it for a long time. They're not getting the cash flow that they would like to earn from it. They want to move into other asset classes that they may not be currently exercising right now. And so now they want to move into something different. And don't forget what we originally talked about in this case study is they're leveraging the ability of the DSCR loan, because the DSCR loan allows them to buy an asset that's based on the asset itself. But of course, they have to come with, money to the table, which hence the 1031 exchange. And it is a win win for the investor. Understand, ladies and gentlemen, there are 100 ways to kill a cat. This is just an example for those who may have asked. Eyes got big when I did that example here, saying down payment of 136,000, and said, well, who has that? There are plenty of people who have that money. And you'll be surprised with how many people who have who own and invest in real estate, have owned it for a long period of time. They built out a lot of appreciation, and now they want to be able to leverage that appreciation to be able to go into another asset class. And that, my friend, is how you would pair, which is what this podcast is about, how you would pair the 1031 exchange with a DSCR investor loan. So there you have it. I wanted to do that because today, like I said, in the real estate community, it's considered 1031 exchange day. Today is 1031. Most people think that it is Halloween. And for those who are in the real estate community and they work in these type of transactions, or have interest in wanting to be able to leverage 1031 exchange to be able to enhance and build out their portfolio, this is the episode that I wanted to do. So once again, this is Lorelia, but as always, if you are someone who enjoys listening to topics like this when it comes to creative financing solutions with real estate in terms of building wealth and expanding your portfolio, this is the place to be. I also want to share with you today's podcast is being sponsored by Fuzzy Fur Pets. If you go to www.fuzzyfurpets, there you will